Okay. So once again, thank you very much for joining this webinar. Today we are going to discuss the role of life insurance in financial planning and especially permanent life insurance. So is everybody is aware how important life insurance is in overall financial planning. So government mandate that we get auto insurance so that we cover the liability of hitting anybody or causing any damage to anybody else. Similarly, we take home insurance is mandatory if you have mortgage because whoever is given you loan, they want to make sure that property is secure against any natural calamities. And but for life, there is no such compulsion or there is no such rule that you must insure your life because it's all personal because there is no other person is having a liability on your life. It's you alone who is having the liability on your life in terms of your dependents, in terms of your family, you know. So, so that's where many people fail to insure themselves adequately as far as life is concerned. And everybody understand that life is very fickle, like it's very uncertain. Nobody can say for sure how long somebody is going to live, and that's the nature of life. Death is as certain as life. So, but still, all over the world, if you look at the statistics, uh, most of the people are underinsured, and almost more than 50% of the population is not insured at all. And that's where we see that if anything happens, like any disaster happens or life goes away at untimely manner, then it creates havoc for the dependents and the family. So to protect ourselves from those uncertainties, life insurance is a very feasible and very easy and convenient way to protect ourselves. Uh, but again, it's not as simple as it is said because there are so many types of life insurance available in the market, and we don't know what is suitable for us, what is not suitable for us. So in this session today, I'm going to touch upon a few key things so that we understand what life insurance is, what is its importance, and how we should approach having a life insurance which solves our problems rather than creating any problem for us in the future. So with that objective in mind, I will just talk about the simplest form of life insurance for a few minutes, and then we will get deeper into the permanent life insurance. So basically, there are two types of life insurance. One is term life insurance, and one is called as permanent or whole life insurance. There are different names for it, but these are the main two categories. So term insurance, as name suggests, is for a particular term, and that term could be anywhere from 1 year up to generally available like 30, 35 years, in some cases up to 40 years also. But there is no term insurance beyond 40 years. Uh, so that is typically the range. So what does it mean that you insured your life at a certain point and you say that I want it for a certain term, let's say for example 30 years. So you premium get decided upfront that how much you are going to pay for next 30 years. That premium will not change. You pay that premium every year, and anytime during that term, as long as if you are paying annual premiums or monthly premiums, then if anything happens to your life, then you will be given a death, like your beneficiary will be given the death benefit which is mentioned in the policy. Now once the term is over, then after that point you can still carry the coverage, but premium will increase because it will be calculated as per your age at that time, not what was decided 20, 30 years ago. So that is the most simplest and most cheapest form of term life insurance which you can get, and it is especially useful in younger age, like as soon as you start working in your 20s and early 30s, and you get married and you got your first house mortgage and things like that. So that time, let's say if you are in your early 30s and you take 30-year or 35-year term insurance, that will cover your entire working life, like up to age 60, 65, or maybe up to 70, depending upon when you take it. So that means that covers your entire working life. And in that time, if anything happens to your life, then your family will get lump sum amount that is completely tax free, and they can carry on with their life, at least financially, without any problem. So, but as it turns out that since the term is limited, it won't cover you till end of your life. At certain point, it's going to get over. And in older age, as you get older and older, getting an insurance becomes costlier and costlier. And you may need insurance in later part of your life more than what you need it in your earlier part of life, because importance is same whether it's in younger years or whether it's in older years. And sometimes need in older years may be more than what in younger years if you're not saved enough and if your assets are not big enough to cover all your retirement costs as well as all your medical care costs in old age. And especially in US, when we see that there is a lot of uncertainty about retirement, government benefits are there, but they are not guaranteed. They are very fluid, like it can keep changing every year, and we don't know by the time we get retired what the policies will be, what the conditions will be. And so that could be a very huge cost in terms of retirement living. And what if we live longer? Normally people think that I won't live beyond 70, 75, 80 years, but that is just a wishful thinking. There is nothing in our hand. You may end up living 90, 95 years or maybe 100 years, who knows. So what is the safeguard you have? Like if you live longer, like because then you may run out of your assets, or the longer you live, the more assistance you will need, because body will get fragile as you get older and older at certain point. So looking at all those factors, then comes the concept of whole life insurance or permanent life insurance or cash value life insurance. These are the different terms used for that kind of insurance. And in that, we are going to have insurance till end of our life, no matter how long we live. So that's the main difference between term versus permanent. Term is applicable only up to a certain duration, but other type of insurance, permanent life insurance, as name suggests, is permanent. It will continue till end of your life. It won't expire in between. So then in that also we have various varieties of insurance, and there also there are so many options are there. So which one works best? So we will look into that today and see what are the pros and cons and options which we should consider, and what all the benefits which it can offer us overall. So with that, let's get started. So for agenda today, we are going to cover what is permanent life insurance. I will give the basics of it. Then we will cover what are different types of permanent life insurance available in the US market. Then we will do a basic comparison of those options and suitability, like in what situation, what, which option suits which kind of audience. Then we will discuss its key features. What are the key features of this kind of policies? What are their key benefits? And then we will deep dive into a specific type of permanent life insurance policies, which is called as IUL or Index Universal Life. And then at the end, we will discuss like what to watch out for. Like when you are, if you are planning to take one, then what are the factors you should look into and what are the things you should be careful about. Because as I said, there are so many options available in the market, so many people are selling it. So we need to be educated at our end to so that we don't end up taking something which is not going to fulfill our objectives. Then we will look at some sample scenarios so that it gives you an idea. And then at the end, we will discuss fixed index annuity, which is not a life insurance, but it fits into the context. So I thought that I will cover that also for a few minutes. And then we will do a comparison of all financial products in the end. So that gives a clear snapshot of how everything compares with each other. You know, whether we do investment in mutual funds or we invest in stocks, we invest in real estate, we invest in our 401ks or IRAs. or we invest or put our money into this permanent life insurance policy. So how overall it compares with each other. So we will look into that. So at the very basic, what is permanent life insurance? So as I said, it does not have a set term. It can run till end of the life. That is the primary key feature of this kind of policy. And unlike term policy, it can have a fixed or flexible premium. So in term policy, as I mentioned, once you take the policy for a certain term, that premium will remain fixed for the entire duration. It won't change. And in permanent life insurance policy, you have both kinds available. You can have a fixed premium for rest of your life, or you can have a flexible premium where you pay more upfront and then pay less or none at the end, or you have flexibility to pay for certain years, stop, and then again continue paying and things like that. And then you can have flexibility in some policies where you can change the premium amount year to year as per your needs and availability of the fund. These kind of policies, as name suggests, permanent life insurance policy, you will reap the full benefit of these only if you keep it till end of your life. If you try to come out of this before end of your life, or you just use it as a short-term measure for 5, 7, 10 years, then it's not going to work in your favor fully. Like it still can give some advantage, but it may not work fully in your favor. So whenever you take it, keep it in mind that I am keep taking it for lifetime. So it's not a short-term thing. You should not look at it from 2 year, 5 year time perspective. You should look at what it is giving me till end of my life, assuming I may die at any point. You may die at a very early age, or you may die after year 100. So, so that's how we have to look at it. And most of the people make a mistake, like when they look at these kind of policies, they start comparing right away in terms of return. So it is not an investment product. It is an insurance first. As the name suggests, it's a life insurance. So its first objective is to provide the life insurance. And at the same time, it provides you some more flexibility in terms of cash value, which you can use during your lifetime. So it is an insurance first, investment later. So you should not confuse that it is an investment. No, it's not an investment. At heart, at the very core design of it, it is an insurance first, and then with in the umbrella, like in the uh, setup of an insurance product, it provides you a benefit of having income or cash value during your living years as well. Because in term, you don't get anything. You just pay the premium. If death happens, you get your beneficiary get the death benefit. Otherwise, you don't get anything. So here it is not like that. Then here you can have, if your objective is to secure your death benefit, that I want this certain death amount no matter what, then you can have that kind of policy where you have guaranteed death benefit, but with no cash value. So let's say if your objective is just to have death benefit, which you pass on to your beneficiaries or your favorite charity, but you are not looking for any income, or you're not looking for any money to withdraw from it. So then you can have this policy which has a guaranteed death benefit no matter how long you live, or up to a certain age, whichever way you want to design it. And but you will not have any cash value to take out during your living years. So that option is also there. Then you can have death benefit, as well as you can have accelerated death benefit and cash value. So what does mean by accelerated death benefit is that is while living, you can still have benefits from it in terms of acceleration. Acceleration means taking the death benefit fast forward way. So let's say you got detected with a terminal illness like fourth stage cancer or something like that, in which doctor declares that you are not going to live more than 12 to 24 months or like that. So in that case, you can take out your death benefit. Let's say you have $1 million death benefit in the policy. So a certain percentage of that you can take it out while you are still alive and use it for your medical needs, use it for your any need. Like you want to have some, you want to travel somewhere before you die, you want to give away something while you are still alive, you want to spend some good time with your family, or some do or take care of your medically well, or make sure that you stay home and then take the medical help at home instead of in hospital, which is not covered by insurance. So varieties of ways you can use that amount before before actual death. Similarly, you can use the benefits from this policy for chronic illness. Let's say you met with Alzheimer, you met with dementia, you met with a stroke, and then you are not able to do your daily living yourself. So that means you need assistance for rest of your life to take care of your basic day-to-day things, and that costs money which is not covered by health insurance or any other insurance. So in that case also, this policy can come handy that you can take out a certain percentage of your death benefit every year, and that too without any paperwork or without any further complication, and use it whichever way you want, no questions asked. And then, as I said, there are varieties of option and flexibility. So that makes things complicated. There are variety of products, number one. Then in each product, you have variety of options. That is number two. And then you have variety of companies in the market. Number three. And then you have varieties of people who are marketing and selling this product in the market. So that makes the overall thing very complicated. And sometimes it goes beyond the general comprehension of people, and they think that, oh, forget it, it's not for me. Okay. But but that's why I'm having this webinar, so that I create awareness and I give some basic uh, knowledge points, so that you know that how it can help, and then based on with that knowledge you can explore the right kind of product for you, if that fits your overall objective. So next, let's cover what are the basic types of permanent life insurance policies. So as I said, there are many. So we'll cover few high level things here. So at a very core, we can divide them into two categories. One is called as whole life insurance, and another is universal life insurance. So whole life insurance is one of the oldest, like more than 100, 150-year old concept. It started in 18th, 19th century, like in 1800. And since then, insurance companies are there, which are still doing business today, and they are offering whole life insurance since that age. So that is the oldest form of life insurance, permanent life insurance available in US. And then recently, like relatively newer concept is universal life, which got prominence in 1980s, like late 70s, early 80s. That's when universal life got their prominence. And then in universal life, you have multiple options, which are like one is guaranteed universal life, which is called as GUL in short. Then you have indexed universal life, which is known as IUL. There are other names for it like LIRP, which is like lifetime retirement income plan. And then there are few other names people have given it like laser fund and max funded IUL and things like that. And then you have variable life insurance, variable universal life insurance. So these are the basic high level types. So you should understand which one you are taking. So in universal life, when you say guaranteed universal life, that means it gives you guaranteed death benefit to start with, no matter how long you live. Or you can restrict, let's say you can say that, okay, I want guaranteed death benefit till age 90, 95, depending upon your own judgment of your life expectancy. And based upon that, they will give you a certain premium, that this much premium you need to pay. And you pay till premium all the years till you die, and you are guaranteed to get that much death benefit. And once you take the policy, then it is covered, whether you die very next day or you live full term. It doesn't matter. But as long as you are living, you have to keep paying that certain premium every year. So this is one of the cheapest way of taking a whole life insurance policy, uh, because the cost or the premium cost on this kind of policies is one of the lowest. Then but then return wise you won't get much, so or nothing, very limited options for return, because it is basically meant for taking that benefit. Then second type of universal life is policies are index universal life. So in this you have flexibility, lot of flexibility, which we will discuss later. And then you can have death benefit as well as cash value. And here the main difference is that in this policy, your investment, like your cash value, is protected from market loss. Like if market goes ups and downs, then your cash value will not go up and down as per the market movement. That's the main key factor there. And variable universal life is again similar concept as index universal life, but here you are not protected from market loss. You decide where your cash value should be invested, and then depending upon that, where you decide to invest, it will grow, it will go down, or your policy may lapse also, because let's say if market goes too much down and then your cash value depleted very fast, then you may be liable to pay either extra premium, or your policy may lapse. So that's why it is called as variable, because returns are not fixed in this kind of policy. So if we do a high level comparison of whole life versus index universal life, because these are the two main, because out of universal life, I will be keeping my discussion focused on index universal life, because that's where the most benefits and most flexibility is there. And then let's look at it in comparison to whole life. So in whole life, since we are not taking any risk, this is the most safest form of insurance. So that's why it has a high guaranteed value. So that means once you take the policy upfront, you will know how much guaranteed returns or how much guaranteed death benefit you are going to get up to what age. And all those guarantees are going to remain for rest of the policy term, depending upon when you take it and how you designed it. In index universal life, you comparatively have lesser guaranteed value. So for example, let's say you are paying same premium in both type of policies, then you will have higher guaranteed values in whole life versus index universal life. But since you are getting higher guaranteed, that means you are getting slow growth also. So in whole life, generally returns are in the range of 2 to 5% on your cash value. But in index universal life, you can get higher growth without taking any risk, because as I said, difference between index and variable is an index you don't lose money. So that means it has a higher growth in the range of 5 to 8% as compared to whole life. In whole life, you have less flexibility in paying premium, because once you set up a policy, then you have to follow the premium schedule. And you have flexibility in terms of designing it, but once you design it, once you take it, then flexibility ends there. Then whatever terms and conditions you decided on, you have to pay premium as per that. In index universal life, you have more flexibility to deal with in case of any uncertainty happens. You plan something, you take policy, you start off with something, but let's say down the road you met with some uncertainties, some emergencies, or some problems because of which you are not able to pay premiums on time. So then you have little more flexibility here. In whole life policy, everything is fixed, so there is no change can be made. Once you take the policy, all the terms and conditions get set, and that's permanent. But in index universal life, you have a lot of flexibility, and in terms of changing the coverage, in terms of changing the premium amount, in terms of changing the investment options, so all those things are flexible. In whole life, generally you have high mandatory premium paying period. You have to pay premium for certain amount. Minimum, in most of the cases, I would say minimum 10 years and much more. But in index universal life, it can be funded with at least 5 years of premium. So this is the least you should fund. And in some cases, I will cover a specific case where you can even fund it with one premium only, single premium. And whole life is suitable for completely risk averse people who don't want to take any risk at all. They just want a bank account or a FD account kind of performance on their policy. So that kind of people will favor whole life. But index universal life is suitable for people who can take little moderate risk, like guaranteed or less. So that means we are taking moderate risk, but with lot of flexibility and controls where we will not lose our principal, like in principle in the sense whatever is the cash value. And we will come to that. What does that mean? So now, as I said, we'll focus most of our discussions on index universal life. Because that's where the focus of this discussion is, which is most flexible and most suitable in current scenario. So that's where I'm putting my focus here. But if anybody has any questions about any other types of policy, so we will take it and we'll discuss about those as well. So what are the features? And some of these features are common across all types of policies. So there is some commonality between all. So immediate death benefit protection, the moment you sign the policy, pay first premium, you are protected and you have the death benefit as per the policy, no matter even if it happens very next day. Then you have death benefit protection for retirement years because it's full life policy. So even during your retirement years, you die, which is the most probable scenario. So then also you will get that benefit. Then, as I said, it has flexible premium. You start with certain premium amount, certain design, but it's not set in stone. So you have flexibility in terms of paying premium if you met with some uncertainty and you are not able to continue paying on the stated terms as you decided early on. Then you have a lot of control in your hand how you want to operate the policy. So as I said, it has various moving parts which you can play around with and adjust according to your needs. We'll discuss some of those as we move forward. Then it gives you tax deferred growth that whatever cash value, whatever premiums you are putting, they will never be taxed as they are growing unless and until you take it out. And there are ways to take it out in a tax-free manner as well, which comes to the next point that most of the time you can have a tax-free distribution from this policy. And also at the time of death, whatever death benefit is paid, that is also income tax-free. And then in these policies, there is no penalty for early access. That means that you can access your money anytime you want. There is no penalty as such, but I will talk about like when it is most favorable. So you should not, as I said, it's a whole life policy. So you should not take it with the objective of using it for your cash needs immediately, like in first 2 3 years of policy. Ideally, you should wait 10 years before you start accessing cash value from the policy. So that way you will get the maximum benefits out of it. And another thing is that in retirement years, you don't have to do any required minimum distributions, unlike the IRAs plan. Because in IRAs, you must uh, take out RMDs once you turn age 73, which will increase your tax liability, which will, whether you need the money or not, you are forced to withdraw. But here, there is nothing like that. Distribution is completely in your hand. If you need, you take it. If you don't need, let it grow, and it will be passed on after that to beneficiary tax free completely. So key benefits are income tax free benefits, then tax deferred accumulation potential, and income tax free loans and withdrawals in later years. So these are some of the key advantages or features. Then when we talk about the benefits, what are the benefits of this kind of policies? So one is like liquidity. As I said, there is no penalty in accessing the cash value as soon as after 1 year of the policy, if needed. You can take out the money, though it is not recommended just because of the performance point of view. Because if you take out the money early on, it will affect the performance of the policy. But you have the liquidity in case of absolute emergency. So it's not like that you can't take any money out. So it acts as your emergency buffer because you can take out money if you need. Then you have safety of principal because it protects you from market loss. If market goes down, your cash value is not never going to go down. Then rate of return, historic average rate of return is in the range of 6 to 9%, as I said, and it's tax free. So it's good. It's not bad return in terms of returns also. Then you have tax advantages. Then you can leverage it. Leverage it means that you can take the money out from these policies in the forms of loan, and that loan interest is most of the cases, if you take it from good companies, it fixed at 5% maximum for the life of the policy. So that means no matter what's happening in outside economy, you can take out money from this policy by paying 5% loan. And rest of your money is still growing at the rate in which you get the return from the policy. So to look at it this way. So in current scenario, let's say you have a mortgage which you took at 2% or 2.5%, 3% few years back. So you took a 500K loan at a 2%, and now the rate interest rate even on a safest instrument like a bank account or a FD or a treasury bill is 5% plus. So that means you are paying 2% interest on your loan, mortgage loan, but you are earning 5% on that. That means you are earning 3% positive on your money. So instead of keeping money in your house, it makes sense to let it run on loan and use that cash, extra cash, to earn more than what you are paying in interest. So same concept goes here. Once you have sizable amount in your policy, you can take it out as a loan and you can use that money for your needs. That is the first objective. But if you find other opportunities where you can earn more than what you are paying as the interest, then you can use that as a leverage as well. So for example, let's say you want to take a education loan. Now education loan for your kid is coming out at 8% or 9%. But here you know that you can just pay 5%. So instead of taking a loan from outside bank for a 9% or 8%, you can borrow from your policy at 5%. That way you are straight away saving 4% interest. Similarly, let's say you have to take a auto loan, which in current scenario it's costing you 9 to 10%. Or for emergency, you need some personal loan, which costs currently around 12 to 13 to 15%. Or you have some credit card debt, which costs 23 to 30%. So you can use money from this policy to clear out your debts or not take debts at all from outside, rather take debts from your policy. So that way you pay 5%, but you have potential to either save more in terms of interest if you've taken it from outside, or in terms of returns which you are going to get inside the policy. Because as I said, this policy gives returns in the range of 6 to 9%, and you are paying only 5%. So that means you have a potential to get positive return on your loan. Then next advantage is it offers you compounded growth because it's a long-term policy for your life. So generally these policies runs for 30, 40, 45 years, 50 years in some cases. So that means you can have lot of compounding happening in these kind of policies, and power of compounding you cannot underestimate. You cannot underestimate. After 10, 15 years, it just grow exponentially. And if you keep this policy for 30, 40 years, it can just shoot like anything. Then it provides you probate and legal protection because it's transferable assets without any probate. It pass on to your next generation without any legal or court proceeding. If you are in some kind of business or you have some liabilities from outside market, then this asset cannot be touched by creditors. If anybody file lawsuits against you or anybody, sue you for something, these assets cannot be claimed. And again, these assets won't count as your assets in terms of your child's education also. So even if you have millions of dollars into this policy, that won't count it as your asset. That means you can eligible for higher financial aid for college education for the kids. Then you can pass on generational wealth, generation after generation, because it's a tax-free money. Let's say your beneficiary get $1 million when you pass away, they can use that money right away to invest further because it's completely tax free. And maybe they take policy for themselves using that same money. And then that will create more compounded growth over the years of their life, which they can pass on to their next generation. So like that, you can create generation after generation wealth. And then it gives you complete abundance, like you can free up your time for other things, and it gives you complete clarity and calm and confidence, and then you can focus on doing what matter most to you in your life. So if you have to give an analogy, this is the analogy which I generally like to give to life insurance policy. Like it acts like a financial Swiss Army knife. So we all are aware of Swiss Army knife, like how in this one we have almost every tool. All kind of tools are there. Small tools are there which can be used for variety of purpose. So it's Swiss Army knife is like used by army, and they can use this for variety of purpose for in their day to day and as well as in emergency situation. So similarly, this particular policy can be used for variety of purpose. Like as I said, you can use it for college saving for your kids. You can use it as an emergency fund. You don't have to keep even 10, 15, 20,000 in a bank account sitting idle, doing nothing or earning nothing. Because, as I said, in case of emergency, you can take out cash from these policies in as less as 2 to 3 days. So you can use this as an emergency fund. That benefit is quite obvious. You can use it as a long-term care fund in your old age retirement. You will may need medical care, assisted care. You can use this for that. You can use it for retirement planning. You want supplemental income, or you want to retire early. If you start early on this policy, then you can use this policy to fund your early retirement, like from age 50 to 60 or 65. because all your retirement accounts or social security will not kick in until before age 60. And if you want to retire early, then you don't have any option if you have not invested anywhere else. So either brokerage account or this policy can come handy in your early retirement planning, or in normal retirement also. If you want to do Roth conversions, then this policy can be used for that. If you want to uh, supplement your retirement income, let's say your social security is not enough for your expenses, then you can use funds from this policy to fund your income or supplement your income, or you can use this for a variety of other purpose. Let's say your basic needs are covered by social security, but you need to travel, you need to give gifts to your grandchildren, or fund their college education or something like that, or you want to give charity in your non-earning years as well. So you can use funds from this policy for all those purposes. It offers tax reduction, as I said, because both withdrawal and growth is tax free. It can act as a pension maximization because, as I said, you can take money regularly out from it if you want at certain stage in retirement. If you are in business, you can use it as your working capital account because you can take money out and then pay back money to this policy as and when you need it. So for real estate professional, this can come out, or any other business where you need lot of working capital, but you have like 30-day, 60-day cash cycle. So instead of borrowing from banks, you can use this as your working capital account. And then you can use it for estate planning and lump sum capital transfer. Like if you have a large enough estate which runs into millions, and so you can use this policy to pass on estate tax free, and then also you can use it as a lump sum transfer, capital transfer to your next generation. If we want to look at it into more detail, these are all the benefits. And here I have said max funded IUL, and I will explain what does it mean in future slides. So max funded IUL, that means if it is designed well, then what all things it can offer you. We already discussed tax benefit, like it protect against tax increases. In my first seminar, I have covered the what are the dangers we are facing in terms of future tax increases, and it's a very real threat. It's not something which cannot happen, which is most likely going to happen. And then it can provide long-lasting tax-free retirement income. Then it provides legal advantage in terms of estate planning, asset protection, protection from creditors. Nobody can touch assets into this account. Then it provides death benefit. It means it gives you peace of mind, and it gives you income tax free distribution, and your value blossom means it increases after upon that, like you pass on tax free to the next generation. And while living, it provides accelerated death benefit. Then, as I said, rate of returns are not bad, in the range of 6 to 8%, and you get tax free access to your funds, and then you get tax free growth. Safety wise, it's complete peace of mind because these are being given by life insurance companies, which are safest companies on the planet. Uh, a well-run life insurance company which has a good market history and good financial positions and good ratings has never gone bust in the history of the financial market. Unlike all other kind of companies, whether they are utility companies or whether they are financial banks or investment banks or technology companies or even consumer staple companies, all of those companies have gone out of business, but not a well-funded life insurance company. It can act as an alternative to stock and mutual fund, but again, as I said, we should not look it as a one-to-one substitute, but as an alternate. Those who are not willing to put money into market at all, and they are very risk averse, then it can be a very fantastic vehicle for them. It protects you against volatile market because there are no ups and downs. You can never lose due to market volatility, and then it works based on the principle of indexing, and I will explain it a little bit, that you lock your returns every year. Every year you get an interest and you lock it, and that never goes away. So that way you just lock and reset the principal, and next year you are earning returns on that principal. So that means you keep going up and up. You never fall back. Then you have liquidity. As I said, you can use it in job temporary job loss or emergency situation. You can access the cash value, take it out. It it is a great alternative to CDs and savings account, because if you are someone who is just willing, who are just putting all your cash savings into CDs or savings accounts, then it's a fantastic alternative because it provides much more return than CDs and savings account. It can act as an alternative to annuities in certain cases. It can act as an alternative to 401ks, IRAs, or it can act as an alternative to real estate equity. Because we discussed this in our last seminar, that how real estate investment or rental in property investment can be very, very, uh, I won't say problematic, but not very lucrative over a very, very long term. Uh, it because of various reasons which we discussed in that seminar. So this can act as a alternative to that, because equity in your house earns 0% return. Because even if your house is on mortgage, let's say you have 20% equity and 80% mortgage, still whatever appreciation you have on your house price is yours to keep. Versus you have it 100% funded, and there is no loan on it, still it will earn the same return. So technically, that means that you are not earning any returns on your capital in the real estate or in the house. And then it can act as an old age care fund. As I mentioned, these are some of the statistics which are official on government websites. Most of them are on non-profit government websites. Uh, so you can see for yourself, like every 66 seconds, somebody develops Alzheimer in US. 69% of Americans will need at least 3 years of some form of long-term care. $228 billion is the annual cost of heart disease and stroke in US. 9.7% increase in your healthcare spending, up to 12,530 per capita annually. Means each person is spending at least this much per year. 6 in 10 Americans live with at least one chronic disease like diabetes, high cholesterol, blood pressure, like that. And 300.5 billion is the total healthcare cost for all individuals only with Alzheimer and dementia, not to mention about other diseases. So healthcare costs in old age is a serious, serious problem in America, and nobody can deny that fact. If we are denying that, it means we are just fooling ourselves. So, and social fabric is like that you will not get help very easily, even within the devotee circle. Don't assume that you will get all the help you need in such kind of emergency. So it's always better to have at least financial backing at our end. If we get personal help, that would satisfy our emotional needs, but at least financially, we should equip ourselves to not depend on anybody in such situation. So here I would like to take a pause and see if there are any questions or comments so far, and then we can continue further. So anybody has any comments can unmute and ask if you have any comments or questions.
Hare Krishna.
Yes, Ravi.
I wanted to ask that, like, say, at this age, I really didn't pay much attention, and I didn't personally take any insurance policies. So at this age of 48, is there any recommendation that can go? It may be definitely expensive, but anything that we can carry at this age to that can
Yeah,
follow up the retirement as well?
right. So, like as I said, like in early years of your life, you take term insurance policies, which is like in your late 20s, early 30s, or maybe late 30s. But permanent life insurance policies generally people take in their mid 40s onward. So that's when it really makes most sense, because by that time you know your career, you are stable in your career, you have your family, you know the size of your family, because by that time children are born, you know when they are going to college, when they are going to graduate, things like that. Those milestones are set. Most probably you got your home and everything, so you know that how much it's going to cost, how much is the loan. And then you have some savings out of your working career of 10-15 years, and then you have stable projection that how much you are going to earn and save in years to come. So ideal age for taking this kind of policies starts after 40. So it's very much like 48 is not a old age. It's a, I would say, a prime age to take this kind of policies. And in some scenarios, like technically you can go up to age 70, 75 also to take this kind of policies. And I will discuss in sample scenarios when that will make sense. So yeah, so to answer your question, as long as you are healthy, like not having much problems with your health, any complicated or terminal disease, uh, it will make sense to go for this kind of policy.
Sure. Is that would that cover some retirement part as well, like
Yes,
long term?
yeah. So that's why design thing come into picture, and when we look at the sample scenarios, then that thing will become more clear. So it has to be designed properly. So most of you would have taken a new house in US would know that you get some sample layout to start with, right? And then you go to design meeting, you go to design studio meeting where you pick all finer parts of it, what kind of faucets you need, what kind of fittings you need. You want to alter anything, you want to create some openings, or you want to create an extra room, you want some extra windows, those finer details, then you finalize in the design meeting, and that gives the final shape to the house you are going to buy. Similarly, here, basic building block remains same across all the policies, but then there are various finer points which you tweak according to your need and according to your objective. And that's where it becomes like a design question, which is very much individual, which cannot be generalized. And
Yeah.
but case to case basis, yes, depending upon your objectives, your financial situations, your goals, it can be designed to suit your needs.
Thank you so much.
Hare Krishna Prabhuji, in IUL, do we
Mhm.
have a single payment option?
Yes, we do have, and I will discuss when it will make sense. That scenario I will cover when we discuss simple scenarios. There is a very
Okay.
specific scenario when it will make sense.
Mhm.
Yeah, Hare Krishna.
Yes, Prabhu.
So you mentioned the whole life insurance is covers whole life death benefit. Even IUL doesn't. What is it? Does it not cover whole life the
Yeah,
death benefit?
it covers, like as I said, both are permanent. Whole life
Yeah.
policy is also permanent policy. IUL is also a permanent policy. If you don't let it lapse, that means you keep on paying your premiums on time, and you don't let policy to get lapsed, then it will run till end of life, both of them.
Oh, so even for IUL you have to pay premium after certain period, or you can stop and it will continue the benefit.
No, as I said, it has flexibility. So depending upon your design, you can
Mm.
stop paying premiums, but you have to monitor the performance of the policy in terms of how much you are taking money out and how much it is, how well it is performing. Because if you take too much money out, then yes, it may lapse. But in
Mm.
most cases, companies provide automatic protection that they won't allow you to take out the entire money, like more than what is allowed to lapse. So at certain point, they will stop you taking money out and then
Mm.
convert it into reduced sum assured whole life policy, so that you don't lose the tax benefits of the policy, and that policy would still run for the lifetime.
Okay. Yeah. Thank you.
Yeah. Okay. So we can move forward if no other questions. So let's discuss some sample scenarios. So this particular scenario is for college funding. Let's say somebody is age 42 and they have 10, 11 years till the time their kid is going to go to college. And for that, they will need 4 years to fund their kids' college, 60,000 per year. So healthy person, 42 years of age, they have enough savings, either already built up in cash because they didn't know how to invest, where to invest. So they have cash sitting already, or based on their savings, they are confident that they can take out 25,000 per year, let's say. So if they invest it like this, then Start away, they will get 500K death benefit. And as you can see here, that benefit will keep on increasing as long as you are paying premiums in the policy. And then after a certain point, like when the time arrives to fund the college, they can start taking out money to fund their kids' college. That is like here in this case, they're taking out 60,000 per year for 4 years. So at the end of this 15 years, they paid 275K in premium. They took out 240K for college funding. Still, they have 187K left as a cash and 400K as death benefit. And anytime in between, if that would have death happens, then they would have got lump sum cash as per the death get benefit column, which will allow them to fund their kids' college anyway. So if they die, then also that thing, that objective of funding the kids' college is not compromised. And if they survive, then also it's not compromised. And the good thing is, which I talked about the leverage earlier, since you are taking this as a loan, let's say at 5%, and you still have 458 accumulation value into the policy, even after taking all this loan. So that means you are still getting interest. Let's say yearly, if you get 6%, 8%, 9% return, you will get that return on this whole principle that will allow your cash value to grow further, even though you have taken money out. So next year, even without paying premium, you may get more than 187K going forward. So let's say you are just 56 and you wait another 10 years without paying any further premiums, then your cash value can again reach to 250, 300K. And if you wait even longer, up to a 70, 75, it can again become up to 500K, 550K, something like that. So that means whatever you spend on college, it has not gone away. It is still giving you protection to fund your retirement years. Most of the times it happens that families save, save, save. They spend on their kids' college. And once they spend it, that money is gone. They are not getting anything out of it. Whatever is spent on college education, that is gone forever from your assets. So that means that you have to save extra for your own retirement needs beyond that point. You cannot leverage on that money anymore because that is gone. So that is one scenario. Then let's say you are planning for retirement income. And as I said in previous example, we funded it for 11 years. In this example, we are funding it only for 5 years. So let's say somebody has saved 200K already in their cash savings over the years, and they don't know what to do with that. They don't want to invest it into the market. This is their surplus. They are looking for options, what to do with this money, sitting in bank, earning nothing, or very limited returns, post-tax return, and not providing any future safety from inflation and taxes. So let's say this person, again, let's say 40 years of age, he invests this 200,000 for 5 years, 40,000 every year. Straight away, they get 736 death benefit out of that get. And then after they stop funding, they can reduce the death benefit from, let's say it has reached up to 900K, but you can bring it down to 700K so that it doesn't cost you much. And then you can bring it down even further after 7 years so that overall cost of the policy you can reduce even further. And as you can see here, as you keep going further, then once they reach 55, let's say their retirement goal is age 55. So there are multiple ways you can use it. You can say that from 55 to 60, I want money from this policy so that I can fund my early retirement. Or you can say I want regular income after age 55 till age 90, 95, 80, 85, whatever. So just to illustrate, this is not a set in stone number. And again, this is not mandatory to take money out once you start every year. But just to give an idea how much you can get is like you can, in this scenario, you can get like around 30,000 tax free for rest of your life uh, just by putting 40,000 for first 5 years. So that is the power of compounding, and that is the power of safety which comes to play here. And then as you can see, the costs are like almost negligible. Like you are just paying 462, 500 every year on a balance of 655K. Because look here the overall accumulation value is 655K, and you are paying the cost of only 700 on that. You can argue that initially the cost is higher, but that is upfront cost which you are paying to get the benefits for rest of your life, because there is no free lunch in this world. So somehow they have to make it financially viable for them as well. But if you compare the cost over the lifetime of the policy, you will always going to get more in terms of death benefit at any point of time, no matter when you die. The early, if you die, then you will get multiple times anyway. But even if you die in later years, you will at least get 5 to 10% more than what the value of your policy is. So most of the cost will get recouped in terms of death benefit anyway. So what is the harm, in paying upfront costs? And these are the upfront costs is put into the policy for a purpose, so that it encourage you to keep it for the long term. You don't come out of it in a short term, because that's when you just kill the golden goose, early on. So so to prevent that kind of behavior, there are high costs and restrictions early on, especially in first 10 years, so that at least if you run to this policy for 10 years, then you will automatically realize its potential, and then you will keep continue it for rest of your life. In the first 10 years are the time when people get jittery, and most of the people come out of it either through some misinformation or through some apprehensions or whatever, and that's where they just kill the whole performance or the whole objective of taking this policy. Another example which we just talked about, like single premium. So this example will be beneficial for legacy transfer. So legacy transfer means you pass on the wealth to your next generation. So IRS does not allow dumping any amount of policy, any amount of money into these policies, because then people can misuse it, to tax-free growth and tax-free wealth transfer. So to prevent that kind of behavior, IRS put some conditions. So that's why ideally you should fund these policies for minimum 5 years or ideally up to 7 years. But in special scenarios where you don't want tax benefit out of this policy while you are living, then you can use this policy like this. Like you pay one lump sum premium. Let's say in this scenario, insureds are age 62 and 61. So it's husband and wife. It's a joint policy. Both are in their 60s. They are close to retirement. They have saved enough. They have worked whole their life. They think that their retirement accounts and their social security and their other assets are more than enough to take care of all their retirement needs. So they just want this extra money which they have to multiply and pass it on to their kids or to their charity or foundation when they die in a tax-free manner. So to achieve that objective, they put 2 million, let's say, lump sum into this policy, and they get guaranteed death benefit of almost 10 million, like 5 times of whatever they are putting. And this benefit is guaranteed till age 95 in this scenario. So that means anytime death happens for both of them, once both of them die, then this much amount will be paid to their beneficiary completely tax free. So even if death happens in age 66, that the amount they will get. Even if they die at 95, that is the amount they will get. So that way, it's a very smart thing to multiply your legacy money in a tax-free way to pass it on. Why you want to save and manage the portfolio, monitor the performance, take all the anxiety, filing the tax returns, shuffling around the investment and this and that, to give certain amount to your next generation or to your favorite charity. This way you can guarantee multiplying your money to pass on without any headache, without any problem. You just put one time and forget it. So single premium policy makes more sense when you don't want to use any living benefit, but want to pass on the benefit as a legacy to the next generation or to your charity. Now, these are all the positive scenarios. Now let's look at what we should not do, or what we should look out when we are taking the policy. So one thing, as I said, the loan options we should definitely consider. What are the loan options in the policy? How you can take money out? Generally, there are two or three loan options are given in each company. One option which is given which is called as a wash loan option or fixed loan option. So in that option, you don't pay technically any interest. So you pay certain interest, let's say 2% or 3% on the loan, but you get credited the similar amount. So technically, you are not paying any cost of taking out the money. It's like you are taking money out of your own bank without any cost. So that is one option. But in that option, you don't get any leverage. Means your money is not growing. You are still where you are. So it will not grow, but it will not cause you any extra interest charges as well. Now, next option is index option, where you can use the leverage, which we just talked about. You take out the loan at certain percentage, let's say 5%, but you can let the money remain invested in the index which you have chosen. So in that scenario, you can earn up to 6%, 7%, or 8%, depending upon the index performance. That means you are earning more than what you are paying as an interest. So that provides an opportunity for your money to grow even after taking out the loan from the policy. And then second is index options. So these policies earn interest based on various indexes which are offered by the policy. So you have to look at what all the index options are being given to me. Are they diversified enough? Are they good enough? Can I use one of the index option in any kind of market scenarios? Like let's say market is going to go down, or economy is in recession, or economy is doing good, or bonds are doing good, or equities are doing good. So can I allocate my money? Because as I said, in this kind of policy, you have flexibility to choose your index once in a year, like change your index once in a year. So do I have enough options, enough variety, and enough diversification to move my indexes on a year-to-year basis depending upon the economic condition, or do I have very limited options? So that is another thing which you should look for on a positive side. Then what you should watch out for. So this is a bad example I have put here. So in this example, as you can see, somebody age 41 paying just 5,000 premium every year. So in all previous example which we saw, we were paying like 25,000, 40,000, and then we are getting the death benefit of let's say 300K or 500K like that. Here, just by paying 5,000 premium, he's being given 500K death benefit. So that's an alarming sign, because for such a low premium, if you are getting such a high death benefit, that means this policy is not going to give you much cash benefit. If you are using this policy only as a death benefit, then yes, it may still make sense that you are just looking for death benefit, not looking for any returns out of it. But then I would argue that in that case, you should go for guaranteed universal life, because that would be even cheaper than this. You don't have to go to this policy for that objective. So if you are young and you are paying regular premiums every year, and your objective is to get that benefit whenever you die, age 90, 95, 100, then IUL is not the right vehicle for that. You should probably look at either whole life or guaranteed universal life. But somebody is being sold this kind of policy just for the benefit of the agent, because the more death benefit they put for a less amount of premium, the more commission they earn. So because of that, as you can see here, just by paying 5,000 premium for 10 years, 50,000 is paid. And if you see the cash value and accumulation value, it is just 39,000 and 36,000. That means it is not even break even with the premiums which you have paid even after 10 years. And initial years, cash value is zero or very low. Even in second year, after paying 10,000, you just have $700 as a cash value. So what are the warning signs? Low or zero cash value in early years. If you see zero on the first row, that is a clear-cut warning sign that this is not in your interest. Period. Very simple way to identify the problem in the policy. If you don't know any technicals also, whenever somebody is showing you some plan in which you see zeros on the first few rows, that means it is not good. Then level death benefit or very high death benefit compared to premium. So as I said, the lower the premium, the lower the death benefit will be. Higher the premium, higher the death benefit will be. So if you have to see from that point of view. If you are paying just 5,000 every year and getting 500 premium, 500K premium, it's a warning sign. That means this policy is not good for you. Just to give you contrast, here by paying 25,000 in very first year, you have 11,600 as cash value. And after 5 years, you paid 125,000 and your accumulation value is 131. That means you have break even in 5 years itself. And if you go up to 10 years, you paid 250 and your cash value is 317. That means it is way ahead of premiums which you have paid. So that means this is a good design. This design is working in your favor because it is giving you cash value growth, which is the primary objective of this kind of policies. And as I said, you can get it for death benefit, but then you should use guaranteed universal life or whole life, or you can use IUL for death benefit when you are in your retirement years, you know that you have surplus, which you just want to pass on to the next generation. Then yes, in that scenario also, then you can use. So this is just very basic testing point which I have given you, just in case if you come across in future, then you should look for this warning sign. So now let's look at the snapshot of all the benefits across, like a comparison of all the benefits or features across various investment options. So on the top row, as you can see, all the options are mentioned. Like if you put your savings in IRA, 401k, or Roth IRA, or brokerage account, or in your home, that is primary home, or in CDs, banks, or bonds, which is considered as safe, or you put in annuity, or you invest in rental income property, or at last you put it into a max funded IUL. So let me touch upon this also because I did not cover that. So what is max funded IUL? So this is not the example of max funded IUL because you can put more dollars here into this policy without increasing the death benefit. So in this policy, I can pay up to 25,000 premium, as we saw in previous example, somebody age 40 for 500k death benefit, they can put up to 25,000 premium also. So here you are paying only 5,000. That means you can dump in extra 20,000 every year if you want to, without increasing the death benefit. So that means it is not max funded. That means you have room to fund it more. But in these examples which I have shown, the moment you put $40,000, $100 also into this policy, you have to increase your death benefit. You can't have the same death benefit and pay more. That means it has been paid to the fullest. It has been paid to the max possible as per the IRS laws. So that's what it is called as a max funded policy versus this is an underfunded policy. So if you have an underfunded policy, then as I said, it will not lead you to the full benefit. Eventually, it will have like performance will dwell down over the years. And you have to keep paying premium into this policy to keep the policy alive. Because let's say if market is down for 3 years in a row, you won't earn any interest for 3 years, then its future growth even affect even further. And to continue with the policy, you may have to pay more premiums into the policy. But if you have a max funded policy, then generally, even after paying first 5 to 7 years of premium, you can still have the policy run for rest of its life without paying any extra premiums uh, in most of the scenarios. So if you look at the comparison across various parameters like liquidity, use, and control, then I have put this in a various yes no options here. So I won't go into detail here because that will take away a lot of time. There are so many parameters here, but I will share the presentation and the link of this video so that you can go through it later. And if you have any question, then you can definitely come back and ask. And I can explain it further. But it is most of it is self-explanatory, but it is just give you a snapshot of all the options so that you can see where which option suits and fits your individual objective. So some of the standout features of IUL as compared to others is that, as I said, safety from market and predictable rate of return and tax-free access to money, tax deferred. These are some of the positives of IUL. It's not tax deductible, but no other instrument is tax deductible except this 401k and IRA account because that's where you get upfront tax saving. But other than that, pretty much all other instruments are not giving you any tax benefits as such. Then another big advantage of this over other asset is tax-free wealth transfer. In all others, it's possible in some scenarios, but here it's 100%. And then leverage you can get, and like as I said, in home mortgage you can get the leverage, which I explained already. And similarly, you can get the leverage here also, but in all other options, there is no leverage you can take. Here you can put your policy as a collateral, or you can take the loan from the policy itself, which you can do for home in terms of home equity line of credit, but in all other options you can't. Then you can have disability and death benefit, which no other option offers except this life insurance policy. In all other investment, you don't get any disability benefit. All other investment, you don't get any death benefit. The moment you die, whatever is the account value, that's the account value get transferred to the next person, nothing more. So now let's talk about few points to understand why this solution really works. So most important thing is it builds automatic discipline of saving, because once you take the policy, you know that I have to pay certain premium every year. So that gives you in a mind that like takes you into the mind of targeted savings, because you know that I have to pay this premium. Just like you have your home mortgage. Once you take the home, once you take the mortgage, you know that this much I have to pay every month. So you save that first, and then you think about investing or saving or spending the remaining amount. So just like that, it builds automatic discipline of saving. Otherwise, it's very, very difficult to practice. Most of the time, you just lose the momentum. Even if you save for few years, and after that you just get loose and you don't continue saving. Second is like it's the best use of surplus cash saving. As I said, I come across so many people who have like 100Ks, 150Ks, 200, or even more than that, just sitting in bank accounts, not even earning interest. Forget about getting anything extra. Still, there are people who are just keeping their hard-earned savings into the bank account like Chase, Wealth, and BOA without earning anything at all, 0% return. So why not invest it and keep it here in these policies if you're not willing to take risk, and if you're not going to invest that money anyway? Next is it makes your cash flow stable so that you don't overspend on unnecessary wants, because the moment you have extra cash sitting in your bank account, you will always be tempted to spend it on something which is not really your want needs. You will spend mostly on your wants. You think that hey, it gives you false sense of security, and you think that okay, I have money, I can spend it on travel or gadgets or some unnecessary things which don't really matter. Next point is that it makes you remain firm on your decision so that you take advantage of compounding. And this is one of the biggest advantage in any parallel. Compounding is called as the eighth wonder of world. Uh, so any investment will give you true returns, like fantastic returns or returns up to its full potential by the principle of compounding. And since the structure of this product, structure of this particular insurance policy is like that, it makes you keep it till your lifetime. That is like over multiple decades. So compounding works to your advantage. Even if you are very old in your 70s and 80s, the compounding is still working without you doing anything on your part. You are not making any decisions, you are not shifting around your investments, you are not worried about the market loss. You still remain invested as if you are in your 40s, and the compounding is doing its magic. So that's where the real advantage comes in. And then since this product protect you from market losses, so it keeps you psychologically happy and steady, because you know that unlike in other direct market linked investment where your value can go down up and down to a very great extent, like plus minus 20-30% in a year or even more, uh, here you will see a slow and steady progress. So that will make you psychologically happy that hey, I put 100,000 and it's not like that I am sitting at 60,000 now. That will never be the case. So that will keep you psychologically happy and steady, and take away some of your anxiety. So again, I will pause here to see if any questions, and then I will quickly cover fixed index annuity for a few minutes, and then we can wrap it up. So any questions, any comments on the samples which I showed or any other?
Hare Krishna Prabhu.
Yes, Mataji.
Yeah, thank you, Prabhu, for wonderful session. So, Prabhuji, I have a question regarding this one-time, a single premium policy.
Mm-hmm.
So, Prabhuji, so for any policy, if you take, they will check the health checkup and everything they do, right? Accordingly,
Right.
they will do. So, for
Right.
this also, is it necessary that they would take, or?
Yes. Any life insurance, it will be subjected to medical evaluation because they are covering the life. So they need to know what is your life expectancy, and that they can determine only by doing your medical exam. So yes, you have to go through medical. So that's why I said, like, if you are looking for this policy for accumulation, then earlier you start when you are healthy and not have any chronic disease like diabetes, blood pressure. That's when it's most beneficial. But even if you have like diabetes or just thyroid or just one or two conditions like that, and you are still in early on, it is still okay. And in later years, let's say in age 60 or 65, even at that point, so the example which I showed in that husband has diabetes and blood pressure both, wife does not have anything till age 60. So that works. Like if you take a joint policy, then they look at whoever is the most healthier. So even if one partner is healthier, then it will work very well to your advantage. But if you have any serious problems health-wise, then yes, you may not get it, or even if you get it, that may become very costly. So that's why it's always advisable to act on these type of things when you are young enough and healthy enough, not wait till too long.
Thank you, Prabhu.
Okay, so I will continue. So I just want to talk about this another type of product. It is not a life insurance. It is more of an investment kind of thing, which is called as fixed index annuity. And many people are not aware of this term or even this type of product at all. So I just want to give some awareness about this kind of product as well, which is available and which is very fantastic for our needs, especially for devotee community. So what does it do? So it is not a life insurance. So there is no death benefit here. Okay, number one. Number two, it is used mainly for lump sum investment. So let's say you have lump sum 100, 200, 500, either from your retirement account, old employer retirement account, or you have some cash savings sitting on the side. You don't know what to do. But for somehow you don't want life insurance. Either you already have a policy or you are covered your assets wise that you think that okay, even if anything happens to me, my family will not be in any trouble at all. So if you don't need life insurance policy, then you can consider this alternative as well. So what are the features of this? The key features are like it gives you guaranteed principal protection. That means your principal will never go down even by a dollar, whatever that amount is. You can get predictable 6 to 9% return, compounded returns over the year, depending upon the current rates in the market. There is no market loss. If market goes down, you don't lose a single dime. If during the term of the contract, if death happens or terminal illness happens or you get confined to nursing home kind of situation, you can take out the entire money from the account without any penalty or charges. There are no mandatory charges or fees in this account, not a single dollar. If there are some charges or fees, but those are optional, and that is designed to enhance your returns. If you want to maximize your returns beyond 6 to 9%, then you can pay certain charge and then increase, have a potential to increase your return. But those are optional, completely up to you. Then you have flexibility to change investment option once in a year. So based upon the market scenario, you can move to the less like more conservative or more aggressive, depending upon the market outlook for the next year, and that too you can do without any charges. It is generally available in the lock-in period of 5, 7, 10 years. That means whatever term you choose, the principal will be locked in for that many years to take out 100%. You can still take out 10% in any year without any problem, or in case of death, terminal illness, nursing home, you can take out full thing without any problem. But in normal scenario, you will be allowed to take out 10% every year till the term is over. Once the term is over, you can take out whole thing if you want. As I said, it is very good for retirement and non-retirement funds both. In non-retirement fund, only word of caution is that you have to consider your tax liabilities, because whatever you earn on it at the time of payout, when you take the money out, it will be taxable as an ordinary income. So if it is your non-retirement funds like post-tax funds, then you have to consider your tax liability depending upon when you are planning to take it out and how much your income will be around that time. But with careful planning, it can be used even for non-retirement funds as well. Personally, for myself, I am using it because I don't keep myself seeing working like this for rest of my life, and definitely not till age 60, 62, 65. So I am planning to use funds from these accounts before age 60. So that way, when I slow down and my other income is going down, I can take money out from it without paying any income tax, even though it is my post-tax money. Or retirement account, if you invest, the tax treatment will be exactly same as the target account was, like 401k if you're transferring, or IRA if you're transferring, then same rules will apply up to 59 and a half. If you take out, you will pay 10% penalty. After 59 and a half, if you take out, you will pay whatever you take out, you pay ordinary income tax on that. And then if you remain invested till 73, then you have to mandatorily take out minimum distribution. So it is an excellent option for any appreciated ex-employer 401k. So let's say if you are in your late 40s, early 50s, or early 60s, and over the years you have invested in your 401k that has appreciated a lot already over the last 15, 20 years. Now you are close to your retirement or already into your retirement. And now safety of principal with still reasonable growth is the objective, because you don't want to get the headache of market volatility and uncertainty, but you don't want your money to just sit idle and not do anything. So it's a fantastic path to take a middle ground and take those surplus amount and put it into this account and still let it grow 6 to 9% on the same terms and conditions, without taking any headache, without taking any stress or anxiety of the market, or worrying about where to invest, how to invest, and things like that. Because as you get older and older, your cognitive abilities and your intelligence and your research capabilities and your decision making capabilities goes down. But if you have money in here, there is nothing much to decide, because everything works on its own. So that way, it's a fantastic thing to make yourself stress free in your retirement years or in your early retirement years as well. So just to give this thing in a pictorial view in this chart, as you can see here, in let's say in 2003, you invested 100,000 into S&P 500 directly, that is 100% into the market, this green line, or this purple line, which is this kind of account where you have 10.5% cap rate. What does it mean? That you are getting maximum 10.5% return on S&P 500. If you choose, you don't lose anything. As I said, minimum is always protected. You don't lose a single dime into this. So let's say from 2003 to 2007, both the green and the purple line were working in tandem, because the returns on the market were less than 10.5%. So any return between 0 and 10.5, you will get the same amount credited to you as well. Now in 2008, we all know market came down 37%. So this green line came down, but this purple line remained where it is, because in down years, you don't lose anything. You remain where you are, you get 0% return. That means you remain flat. Now, when market starts moving up again in 2009, this green line has to do catch-up work to reach to the same point where it left. And it happened in late 2012. As you can see here, it reached to that point once again in 2012. So it took almost 4 years for it to do just the catch-up work. But in purple line, since we did not fall, let's say at this point we were at 120, so we remain at 120, and then as soon as market starts going up, we start going up once again from that point onward. So that's how this purple line is keep going up and up and up only, never comes down. But this green line, every now and then when market goes down, it comes down. Now, as an exception, you can see that in last 3 years during COVID time, market just went out like anything. It was crazy. So you see that this green line has overshoot the purple line. But in 2022, again, market went down by 19%. So then again, it fell below. Again, it went up, but then again, now we are seeing last few days, last week or so, market is again down by more than 8%. So even in 20 years of time frame, if you see, even if you compare with 100% equity market performance, direct investment, if you compare, like out of 20 years, 18 years, you are ahead of the market. And tell me who in their retirement years will have a courage to keep all their savings 100% into equity. Most probably you will have a portfolio like 60-40 where you will put 40% in bonds, 60% into equity. That means that your green line will still further go down, because then your average returns would not be as market, it will be even lesser. But here in this option, you can remain invested in 100% equity option because you have 100% protection. You can't lose a single dollar. So that gives you fantastic protection and still take the full returns of the market. Up to a certain extent, up to the cap, which is 10.5 or 11% in some cases, and risk-free, worry-free, anxiety-free in all your golden years without any problem. So just I wanted to share this as well, because there are many people out there who have no idea that something like this exists. So with this, I would like to end my presentation today. And as I have requested in previous seminars also, I am requesting all of you to support to save cows. If you are inspired, we have a project in D-Land, Florida, where there are 15 cows are being taken care for their lifetime. They were supposed to go to slaughterhouse, but those were recovered and being taken care for rest of their life. They are not milking cows, old cows, but we are taking care of them for their life. And we need to build a cow barn, and there are a lot of expenses to take care of them, to feed them, to take care of their medical needs and all. So you can check out the project details at vedafoundation.net. And if you feel inspired, you can give your contribution either through Zelle or PayPal at info@vedafoundation.net. You will find the information on website as well, and you can use the link on website as well to donate if you want. And these are my contact details. If you want to reach out to me, you can reach out to me via phone, WhatsApp, or email, as mentioned here. With this, I will end my presentation here. And if you have any questions or any further final comments, we can discuss. Yes, Ashok.
Hare Krishna, Prabhuji.
Yes,
Dandavat
Prabhuji.
Pranam.
Yeah, Dandavat Pranam.
Prabhuji, if you have, regarding Roth IRA, can you do that? Can you put transfer money into that fixed annuity?
Yes.
Like, as a Roth.
Yeah. So as I said, in annuity, the tax treatment always depend upon the target account. So if you are moving money from Roth, you can put money into annuity, and whatever you take out will be completely tax free, just like Roth account.
Okay.
But you can save, you can save yourself from a headache of market volatility and all. You will still have predictable growth. And when you take the money out, there won't be any tax, or even if you pass on that asset, that will be completely tax free because it's a Roth account.
Okay. So the second question I have is, most of us, we have, what is that, insurance policy through employer.
Yes.
So is it a good idea, let's say when we leave a job, or we get, if we lose a job, for example, we have a window to basically convert it into what is that? They give us some kind of window, right?
Right.
So what do you do in the, what decisions can you, what is the right decision to do to make that time?
Yeah, so I would not recommend. So that's why I always educate and I always stress on the point that don't rely on employer policy, because that is tied to your employment. And the moment you are retired or the moment you are out of that particular job, that policy is either not applicable, or if it is applicable, it will be just like an individual policy, because no longer group rates will apply. So you have to, it is just like as if you are applying for a fresh policy, and depending upon your health condition and depending upon your uh, other factors, it can cost you a lot, and it may not be fitting into your whole objective. So life insurance is such a personal thing, as I mentioned in the beginning of the presentation, that nobody else is having liability on your life except you. So you should protect it yourself with your own personal life insurance policy, which is not dependent on anything else. So, and the earlier on you take it, as I said, when you are young and healthy enough, the better it is for the long term. So that is my recommendation, because if you rely on employer policy, you have to go by their terms and conditions. You hardly have any flexibility there. And once you retire or once you are out of the job, it's as good as you are applying afresh. So it make no difference whether you are taking the same policy forward or you are applying a brand new in the market.
Thank you, Prabhuji.
Yeah.
Appreciate.
Okay. Any other questions or comments, feedback?
Thanks for taking this session, Prabhuji. A lot of information, very useful one.
Yeah. Thank you, Prabhuji. Yeah. So Prabhuji asking any good company for FI. So there are many available in the market, and the rates keep changing because it all depends on how much you are putting, which state you live in, you know. So there are many good companies in the market. So if you reach out to me personally, I can, based on your situation, I can look at and I can suggest which ones are the best ones. But as I said, like it's very individual. There is no generic one company which is good for all situations for all people. So we just have to weigh it down based on the personal situation. Okay. Any other comments or questions? Okay. So if not, we can stop here. And I would again like to thank everyone for joining this seminar and giving me this opportunity. And I hope it makes some sense for you and help you to make your decisions more informed way going forward. And if anything I can help you with, please let me know. I will be more than happy to guide you or help you decide if you want to go forward with any of these options. Okay. Thank you.
Thanks,
Hare
Prabhuji.
Krishna.
Thank you.
Thank you,
Hare
Prabhuji.
Krishna.
Hare Krishna.